Chipotle didn't just build a successful restaurant chain, it invented an entirely new restaurant category. Fast casual sits between fast food and casual dining. Counter service speed, visible food preparation, and ingredient quality that makes a burrito a considered purchase rather than an impulse transaction. Every major competitor since has been chasing a format that Chipotle defined in Denver in 1993.
Steve Ells opened the first Chipotle with $85,000 borrowed from his father, a trained fine dining chef, applying professional kitchen discipline to a simple idea. Make the best burrito possible from fresh ingredients, assemble it in front of the customer, price it at a slight premium to fast food. The model worked so well that McDonald's invested in 1998 to fund national expansion.
The McDonald's backing accelerated Chipotle to 500 locations by 2005, but the operating philosophies were incompatible. McDonald's wanted franchising. Chipotle refused to give up company ownership of its restaurants. When Chipotle went public in 2006, shares doubled on the first day of trading, McDonald's fully exited, and Chipotle operated entirely on its own terms.
The decision to never franchise is the most consequential structural choice Chipotle ever made. Every one of its 3,726 restaurants is company-owned and company-operated. There are no royalty splits, no franchisees cutting corners on guacamole portions, no quality variation from a network of independent operators. Every dollar of restaurant-level margin belongs to the parent company.
The 2015 E. coli outbreak was the most damaging event in company history. 500 illness reports across 11 states, a 40% stock decline, and a near-complete collapse of customer trust. What happened next is the more interesting story. Chipotle rebuilt food safety protocols from the ground up, hired Brian Niccol from Taco Bell as CEO in 2018, and turned the crisis into a complete operational reinvention.
Niccol's transformation was digital first. He launched the Chipotle Rewards loyalty program in 2019. It hit 10 million members in the first year. He introduced dedicated digital make lines inside restaurants, separating in-store order assembly from app and web orders to eliminate the operational friction that was slowing throughput. Digital transactions are now 37% of all orders.
The Chipotlane is the physical expression of the digital strategy. It's a drive-through lane where customers pick up app orders without entering the restaurant. No menu board, no speaker, no ordering at the window. New Chipotlane locations generate roughly $200,000 more in annual revenue than traditional builds, while requiring fewer labor hours per transaction. Over 70% of new unit openings now include one.
The unit economics justify the premium valuation. Chipotle's average unit volume is $2.9 million per restaurant, among the highest in the fast casual category. Restaurant-level operating margins are above 27%, meaning each location keeps more than 27 cents of every revenue dollar after food, labor, and occupancy. New units recover their build cost in under 3 years.
The simplicity of the menu is a competitive weapon that's easy to underestimate. Burritos, bowls, tacos, and salads, assembled from the same core ingredient set of proteins, rice, beans, salsas, and toppings. The tight SKU count means every ingredient gets ordered in volume, stored efficiently, and prepared fresh daily. Food cost as a percentage of revenue stays structurally lower than concept restaurants with larger menus.
The digital loyalty platform compounds the unit economics. 40 million Chipotle Rewards members receive targeted promotions calibrated to their order history, a free entree to drive a lapsed customer back, a double-point event to spike transaction volume on a slow Tuesday. The app creates a feedback loop where Chipotle gets better at marketing to each individual customer the more orders they place.
The competitive position in the peer comparison reflects Chipotle's structural advantages. The unit economics score of 92 is the highest in the comparison. McDonald's at 80 and Starbucks at 75 both operate in categories with either more commodity exposure or higher format complexity. The labor cost risk score of 42 is the peer group's lowest, reflecting genuine exposure to minimum wage legislation, as Chipotle's business is labor-intensive at the restaurant level.
Scott Boatwright became CEO in September 2024 when Niccol left for Starbucks. Boatwright spent 7 years as Chipotle's chief operating officer. He built the Chipotle rollout infrastructure, managed the supply chain during COVID disruptions, and oversaw the throughput optimization initiatives that drove restaurant-level margins above 27%. The strategy continuity is deliberate.
The domestic white space thesis is anchored in management's publicly stated target of 7,000 total U.S. locations, nearly double today's 3,500. Chipotle's restaurant density in mature markets like California and Colorado significantly exceeds its density in large underserved markets in the Southeast and Midwest. The build pipeline supports 285 to 315 new openings per year, nearly all with Chipotlanes.
Chipotle built the dominant fast casual franchise by staying relentlessly simple. One menu, one format, one supply chain. And the discipline to never franchise a single location means every dollar of restaurant-level margin flows directly to the parent company, rather than being split with an operator who might cut corners on ingredient quality or food safety protocols.
The growth thesis today is about two compounding vectors. Domestic white space, where Chipotle sees room for 7,000 total U.S. locations, nearly double today's footprint, and international expansion into markets like Canada, the UK, and Western Europe, where the fast casual format is structurally underpenetrated relative to the U.S., giving the company a decade of unit growth on top of ongoing same-store sales leverage. Chipotle reported Q1 2026 revenue of $3.09 billion, up 7.4% year-over-year, beating the $3.07 billion estimate. Adjusted EPS of 24 cents missed the 25-cent estimate. Comparable restaurant sales returned to positive at plus 0.5%, ending 3 consecutive quarters of negative comps. Transactions grew positive for the first time in 4 quarters. The stock rose 5 to 7% after hours.
Chipotle Mexican Grill was founded in 1993 by Steve Ells in Denver, Colorado. Today, the company operates over 3,700 restaurants across the United States, Canada, Europe, and the Middle East, all under the single Chipotle brand. Chipotle pioneered the fast casual restaurant model, counter-service burritos and bowls with higher quality ingredients than traditional fast food at a slightly higher price point. The Chipotlane drive-through pickup format now represents 80% of new restaurant openings.
At $46 billion in market cap, Chipotle trades at 33.5 times forward earnings, a significant premium to fast food peers. CEO Scott Boatwright took over in October 2024 when Brian Niccol departed for Starbucks. Boatwright was previously Chipotle's chief operating officer. His recipe for growth strategy focuses on throughput improvement, digital sales expansion, and international unit growth toward a long-term target of 7,000 global restaurants.
Q1 2026 revenue of $3.09 billion beat the $3.07 billion estimate, a 0.7% outperformance. Revenue grew 7.4% year-over-year. Adjusted EPS of 24 cents missed the 25-cent estimate by 1 cent. Operating margin was 12.9%, down from 16.2% in Q1 2025.
Comparable restaurant sales returned to positive in Q1 2026, up 0.5%, ending 3 consecutive quarters of negative comparable sales. Transactions grew 0.6%, the first positive transaction growth in 4 quarters. Average check was down approximately 10 basis points. The transaction inflection was the single most important data point in the quarter for investors tracking the recovery thesis.
Restaurant-level operating margin was 23.7%, down 250 basis points year-over-year from 26.2%. The compression reflects beef cost inflation, higher freight expenses, and elevated labor costs. Chipotle's menu pricing in the 1 to 2% range for full year 2026 is not fully offsetting commodity and labor inflation.
Digital sales reached $1.2 billion, 38.6% of total sales. The Chipotle Rewards loyalty program drives repeat visits and digital order attachment. 49 new restaurants opened in Q1 2026, including 42 with Chipotlane. The company targets approximately 350 new openings for full year 2026.
International expansion is the long runway. Chipotle has over 300 restaurants outside the United States, primarily in Canada, the United Kingdom, France, Germany, and the Netherlands. International markets represent less than 10% of the total footprint today. Management has identified Europe and the Middle East as the primary international growth corridors over the next decade.
Operating cash flow in Q1 2026 was approximately $520 million. Management maintained full-year guidance for approximately 350 new restaurant openings. Same-store sales guidance of about flat to plus 1% for full year. 2026 signals a gradual recovery, not a V-shaped rebound. Q2 2026 comparable sales are expected at approximately plus 1%.
Scott Boatwright became Chipotle's chief executive officer in October 2024, following Brian Niccol' departure to Starbucks. Boatwright joined Chipotle in 2017 as a regional officer and rose to chief operating officer by 2023. His recipe for growth strategy centers on 4 pillars: food safety and culture, talent management, throughput improvement, and digital expansion. Boatwright has accelerated the Chipotlane rollout and refocused management on operational excellence.
Analyst consensus heading into Q1 2026 was approximately 28 buy ratings, 12 holds, and 3 sells on CMG. The average price target was $45, representing approximately 36% upside from the pre-earnings price of $33. After the revenue beat and transaction inflection, analysts reaffirmed buy ratings while noting the EPS miss.
The bull case centers on the transaction recovery thesis. Chipotle spent 3/4 of 2025 losing traffic, a combination of consumer pushback against price increases, a marketing reset under the new CEO, and competitive headwinds from fast casual entrants. The Q1 2026 comp at plus 0.5% suggests the traffic decline has bottomed. If transactions accelerate through Q2 and Q3, the margin recovery will follow throughput gains.
Morgan Stanley maintained overweight with a $48 target post-earnings, calling the transaction inflection the most important print in 6 quarters. Throughput, measured as peak hour entrees per hour, is the key operational metric. When throughput improves, fixed costs like labor are spread over more revenue, expanding restaurant margins without requiring price increases.
More cautious voices noted the EPS miss and about flat full-year comp guidance. JP Morgan maintained neutral with a $38 target, arguing the transaction recovery at plus 0.6% is too weak to justify 33 times forward earnings. At consensus 2026 adjusted EPS of 97 cents, CMG must execute on both throughput and cost recovery to sustain its premium multiple.
Consensus takeaway: the quarter confirmed the transaction floor at 33 times forward earnings. CMG prices in a recovery, but not a V-shaped one. The flat same-store sales guidance for full year 2026 means the real upside is in 2027, when margin recovery, international expansion, and throughput gains drive the next leg of EPS growth.
The bull case is a transaction-driven margin re-rating. Chipotle's restaurant-level margin peaked at 28% in 2022. As transactions recover and throughput improves, restaurant margins can expand back toward 26 to 27% without requiring meaningful price increases. Every 100 basis points of restaurant margin expansion adds approximately 12 cents of adjusted EPS annually.
International expansion is the second growth vector. Chipotle's European units, primarily in the UK and Germany, prove the concept travels. A long-term target of 7,000 global restaurants doubles the current footprint, implying 20-plus years of unit growth. New Chipotlane restaurant economics demonstrate 30 to 40% returns on invested capital.
Menu innovation is the third driver. Limited-time offerings like chicken al pastor and smoked brisket drove meaningful comp lifts when on menu. The 2026 pipeline includes new protein options and expanded sides. At 33 times forward earnings, a recovery to 20+% EPS growth justifies re-rating toward the historical 40 to 45 times multiple.
The bear case starts with cost inflation pressure. Beef prices, Chipotle's second largest protein after chicken, have risen sharply in 2026 due to herd rebuilding cycles. Freight costs remain elevated. Menu pricing of 1 to 2% does not fully offset commodity and labor inflation, creating a structural margin headwind through 2026.
Competitive disruption risk is underappreciated. The fast casual segment has seen new entrant growth. Cava Mediterranean Grill is expanding rapidly, Sweetgreen is adding protein bowls, and regional Mexican chains are gaining traction. If consumers perceive comparable quality at lower price points from competitors, Chipotle's traffic recovery stalls before reaching sustained positive comparable sales.
Valuation compression is the third risk. CMG at 33 times forward earnings prices in a recovery to 20+% EPS growth. If comparable sales remain near flat, as management guided, EPS growth from cost leverage alone is modest. A re-rating from 33 times to 25 times forward earnings represents 24% multiple compression even without any earnings revision.
Management transition risk is real. CEO Scott Boatwright has 13 months of runway with the recipe for growth strategy, not enough time to fully assess execution capability. Brian Nichols' departure removed a best-in-class brand builder at a critical time. If Boatwright's operational focus comes at the expense of marketing reinvestment, traffic recovery could stall.
The fast casual peer comparison, CMG versus McDonald's, Yum Brands, Starbucks, and Darden restaurants. McDonald's at 21 times forward earnings is the scale benchmark, 37,000 global locations versus Chipotle's 3,700. Yum at 22 times owns Taco Bell, Chipotle's most direct Mexican quick service competitor, plus KFC and Pizza Hut globally.
CMG at 33.5 times is the highest multiple in the peer group by a wide margin. The premium reflects a superior unit economics story, average unit volumes approaching $3 million annually, restaurant margins that can recover to 26 to 28%, and a long runway of unit growth unavailable to mature peers like McDonald's and Yum.
Starbucks at 24 times is the recovery peer analogy. When Brian Niccol left Chipotle for Starbucks, the market paid a turnaround multiple. Starbucks is executing its back to Starbucks strategy under Niccol. Its 24 times reflects the recovery narrative. CMG at 33 times already prices in a full recovery, leaving limited margin of safety if comp sales disappoint.
The peer takeaway: CMG is the only pure-play fast casual in the group with meaningful unit growth remaining. The 7,000 restaurant target versus 3,700 today justifies a premium multiple. But the premium is contingent on traffic recovery. If Q2 comps disappoint versus the plus 1% guidance, CMG's multiple compresses faster than any peer in the group.
Pre-earnings options positioning was cautious. The put-call ratio was approximately 0.92. The options market implied a 7 to 9% earnings move. The actual 5 to 7% after-hours gain was within the implied range, confirming that options traders correctly anticipated elevated volatility around the transaction inflection print.
Post-earnings call activity focused on the $35 and $37 strike calls for June expiry. The thesis: CMG's Q2 2026 guidance of plus 1% comparable sales, if achieved, would confirm the recovery trajectory and drive institutional rotation into the name. Hedge funds underweight CMG during the traffic downturn were expected to rebuild positions as the thesis validated.
CEO Scott Boatwright's compensation is tied to comparable restaurant sales growth, restaurant-level margin, and new restaurant opening targets. Chipotle does not pay a dividend. All excess capital is returned through share buybacks. The company repurchased approximately $250 million in stock during Q1 2026, consistent with a full-year buyback target of $800 million to $1 billion.
Chipotle's capital allocation philosophy is growth first. New restaurant development receives priority over buybacks, and dividends have never been paid. The unit growth model is the primary return driver for long-term shareholders. Chipotle economics demonstrating 30 to 40% returns on invested capital means management believes reinvestment in new units outperforms buybacks at current restaurant development costs.
Chipotle delivered 7.4% revenue growth, transactions positive for the first time in 4 quarters, 49 new Chipotle restaurants. The EPS miss at 24 cents is the yellow flag. At 33 times forward earnings, recovery is priced. Execution is the risk.
Watch Q2 comparable sales versus the plus 1% guidance. the gating metric.